What's up? What's up, guys? Wanted to do another video for you. I thought it was going to be something I wanted to share with you. And this is you guys have all heard of the 80/20 rule. Well, when you're investing in real estate, okay, so and I'll speak about this from two directives. So, like, you're a person investing your money with someone like me who invests in real estate. So you're investing in the fund, you're investing in the syndication, whatever. That's one way, and then the other way is doing it yourself. But this formula is relative to you too if you're just a passive investor in a deal, right? You're a passive investor, passive partner. Or you're an active person, you're going off, you're doing your own deals. This is probably the most valuable video I'm going to make for you because I want to share with you guys something. And if you guys have ever heard of the 80/20 rule, basically it says that 20% of your work produces 80% of your results. Well, in business like this one, 80% of the work of investing in real estate, the 80% of your time, your energy, your resources is going to be spent on the deal. Reason why is because the deal brings in the other 20% that is required to actually close the transaction, right? So for me, I spend 80% of my time underwriting deals, driving properties, going to properties, calling brokers, following up on the brokers who have the deals, calling the groups of investors that own these assets here in my market, other markets, from California to Texas to Arizona to Florida to North Carolina to all the other markets that I'm looking at. Not that I'm going to buy in those markets, but those markets based on their major cities are relative to the market that I focus on, which is San Diego County and Orange County, right? And I look in Hawaii as it relates to Honolulu. So why is that important? If 80% of your time is looking at 100 unit deals, 200 unit deals, 300 unit deals, 1,000 unit portfolios, now I look at 50 unit deals, 70 unit deals, small properties. I look at everything. Here's why. Not that I'm going to buy everything. Don't waste your time, but you need to understand what everyone else is looking at, what the market is doing, and what people's options are. That's 80% of your time is going to be spent time, energy, and resources building a network, looking at deals, evaluating deals, back of napkin math. And then when you find something that you like that you want to look at even deeper, now you're getting all of the financials, the T12, the T3, the current rent roll, the last 2 years financials, like going in and getting in these brokers networks and Rolodexes and getting emailed all their stuff, going into the deal room, taking a look at financial underwriting, taking a look at all the soft quotes for the debts. That's still deal specific to even find out if that deal works. 80% of your time is going to be spent on that, and it should. And if you're investing with somebody else, you need to know that they're doing that. I have a team. I'm also I'm the team. Plus, I got professionals on my team that take a look at deals, send me deals, underwrite the deals outside of my own underwriting. They don't see my underwriting. I see theirs. I don't share that with them. If they ask me for it, if a lender asks me for it, I send it, right? Because they want to see those things. So 80% of your time is spent on the deal. The 10% on your time, 10% of your time after that is spent on the debt. What's the soft quotes? What's the market looking like? Finding different lenders to be able to shop the debt. Because if you don't have a great commercial mortgage broker, man, you're going to be dead in the water. You need more than that. And you need to know what the rates are, the treasury is, what index are they using, what's the spreads, where else is this financing happening, what's going on, what is the thing that the debt market, which is your biggest partner, they're going to give you 60-70% of the financing. Like, what are they looking at about the deals that you found, about the markets that you're in? What do they think the appetite for lending is going to continue to be in this market? How are they faring out there? Because they're getting all beat up right now with the market the way that it is, with the feds promising to cut rates coming up here soon, but they're not. Everyone's sitting on the sidelines. There's a ton of equity sitting on the sidelines, not doing anything, which means there's a lot of deals that are not getting traded. So these lenders are having a tougher and tougher time getting the financing and getting the rates that we need to make deals pencil, right? So that all matters as you look at the 10% of your time while you're out 80% of the time looking at deals, circling back to the debt people, your finance people, the people that are going to be getting your debt from, your financing from, talking to them about what you're seeing, and then making what they share with you also retrofit on top of yours, right? You got to have that. That's all data. This is data driven. Next, the other 10% of your time, which is the 20, the 10, 80% is the deal, 10% is on the debt, and the other 10% is on the equity. Talking to equity partners, unless you have your own equity, you're going to buy your own deal, you're going to use your own money, whatever. But if you're talking to a partner now, what are the returns they're looking for? How are you going to manage and get them these returns? Are you going to self-manage? Are you going to have a management company? How are you making sure that you can explain what their internal rate of return is going to be, what their equity multiple is going to be, how long you're going to stay in this deal to be able to say, hey guys, this is what I think we're going to make on the deal. I'm going to manage the manager. Here's the returns you're going to get. Here's my marching orders to make sure that I hit those returns. Here's how long we're going to stay in. All of these things have to be done. That this is the 80-10-10 breakdown of how much time you got to spend working to even get a deal at all in the real estate space, multifamily real estate space. So if you can't find a deal, if you're not spending 80% of your time looking deal after deal after deal, market after market, location after location, physically seeing the asset before you dart off to do anything else. And now you're looking at the financials. Does this deal make financial sense? Is it hitting my investment criteria? What are mine? Capital preservation. It has to cash flow. Future appreciation. It has to have some, we need to be able to get good debt and leverage on this thing. And can we scale? I talked to a broker the other day. We're looking at a deal for, I think they were coming to market for like 30-40 million, 35 million, somewhere in that 37 million. And I was like, my goal is to get at least 1,000 units in this market. If I'm going to enter this market at all, I got to get 1,000 units around this one. And she was like, well, I don't think that's going to happen. There's not going to be 1,000 units come up and around this property. And it killed that opportunity for me because I'm like, all right, if I can't get to scale there, I'm not interested. That's a deal thing for me. Right. So, and that's got to be a deal thing for you. So some of the people that want to get into this business, man, do it. We're not in competition with each other. I'm competing against banks. The banks that won't talk to you guys, Goldman, JP Morgan and all that stuff. Like that's who I'm looking for. I'm looking for people who have money, want to invest in institutional quality assets. Now I'm looking at buying the same assets they are, but I'm doing it with the little guy. I'm competing against banks. So if you go off and you bought a bunch of deals and I went off and bought a bunch of deals, I'm not a competitor. You're not a competitor. We together collectively can actually survive in a world where there's like JP Morgan Chase, Blackstone, like these BlackRock, these big investors. We can finally survive in a world if we all came together and bought a bunch of properties, which is why I like to share this information, whether you do it with me or you do it by yourself. Next, the debt. Once you find a bunch of deals and you start collecting data about all the assets, you and your team, or you doing it by yourself, or you hear me talk, this is what I go to my debt guys with. Hey guys, I saw a property like this. Hey, what are you seeing about this? Or some of the deals I look at that when we go in their deal rooms, I call their debt team, right? And I'm asking, hey, how'd you underwrite this thing? What are some of the assumptions you're taking? When you what are you thinking as expectations on this property so far as the debt, and what are you seeing out there? What do you think is going to happen? Right? What's the worst case scenario on this property as it relates to the debt is concerned, moving towards where we want to go based on when I share with them what our targets are to hit. They'll tell me, hey, you got to do this, you got to do that. This may not be a good one. The financing is going to be tough, or you can get into this deal and turn around later and do this with the financing and the debt. And here's what we are seeing: Fannie Mae, Freddie, insurance companies or life insurance companies, the debt market, debt funds out there, all the other different financing options that are coming up available. So that's important, right? Because that's the debt piece. That's only 10% though. That's after you've 80% of your time. And then the other piece is going to your investor pool, whether you're the investor or someone like me that's going out to my investor, all of my family, my friends, my business associates, my connections on social, and saying, hey guys, I think my target on this is 15% internal rate of return, anywhere from 12 to 15% internal rate of return on our hold period on this deal. And I think this deal, we double and triple on the out. I know we're going to make money, and here's how. I just did a video on that. If you want to go back and watch that video there on the ways that we make money in the deal. All right. That's important to know how much time you have to spend, because I see a lot of people who are like out there trying to raise money and they think they're going to get a deal without looking at a lot of deals out there, but they're talking to investors and like, hey, we got this, or we're doing a fund to fund, or we're doing a syndication, and they're running around, but they've only seen 4 or 5 deals and they're swearing up and down this deal is going to crush it. You don't even know the market or the location you're in if you haven't looked at 25, 50, 100 deals, not just in your market, a lot of markets. So you really understand either one, where your market's going, or two, where the market that the deal that you're looking at is going to be moving away from. Some markets that are up right now are going to not be the same in 10 years, but you can tell the direction that the properties you're looking at, sometimes the locations, the markets, what's coming with looking at other markets. Some markets are going to shrink, some markets are going to get big, but I can tell you, if you don't spend 80% of your time on the deal, 10% of your time on the debt, and the other 10% of your time on the equity, this is before you get anything, right? Unless you're investing with someone like me, you hear where our time is spent. So you guys know the time that you spend on the money, the equity. Oh, I got to get the down payment. Like that's the least important part to spend a lot of your time on. Because if you don't have a deal, you don't need the down payment. If you don't have a deal and you can discuss the debt with a lender, they're going to tell you how much money you need to put down. Plus your closing costs, all the other stuff that you're going to need. And that's just the down payment and the equity. That's not including the inspection costs, the time that you're going to spend, your closing costs, your appraisal stuff, your broker's commitment, your broker fees, and all these other things that are included in that cost. All of these things are valuable, but the most time by anybody that's going to be successful in this, they're going to spend 80% of their time on the deal, the location, the market, the demographics, figuring out what's a good deal to them, because it's going to be different for everyone, right? We like institutional quality, class A, class B plus properties in great locations, in some of the top markets, top cities in the world, right? For me, other people may want something else. That maybe they want a C-class property, workforce housing, like it doesn't matter. But I know 100%, 80% of the time is going to be spent on that. So anybody that's raising money for you, that's not telling you, look, guys, we spend, myself, my team, and all the other relationships that I have in my network are built around this breakdown, 80, 10, 10, man. And you're going to invest money with them. If you need to be able to say, hey, how many deals have you looked at? What is the data? Can you show me the information, the addresses, the amount of units, how many times you go to look at stuff? All of these things matter because they're a part of this, right? So especially if you're going to invest with a fund manager like myself, our job is to not lose capital, and you're going to lose money if you don't look at enough deals to know what's a good deal for you. Or if you're investing your own money, you're going to lose money if you're not looking at enough deals to know what's a good deal for you and where you want your money. If you're not going to leave it in the bank and have it die, you're going to put it in a piece of real estate. You need to make sure it's the damn perfect piece of real estate for you and your investors, which is what we do at Bell Capital. So, man, I appreciate you. I hope this thing helps you. Again, remember, 80, 10, 10. 80% of your time is spent on deals. 10% of your time is spent on the debt. The other 10% of your time is spent on the equity. The rest of it all really comes together because the people associated with those three components are going to become your network. All right. So I hope that helps you guys. Like this video, share this video, comment on this video. If you have a comment, I would love to talk to you personally. I like doing that. If you hate this video, give it a thumbs down. Don't be a hater and a hider at the same time. But I know you love this video. You guys love what I'm sharing with you because I hear from you guys. And I wanted to make sure to put more information out there about what you guys want and also what my experiences are with that, because I can only come from my experience, not other people. So have a great day today. I appreciate you guys. Let's go.